Hey everyone. Since the onset of the pandemic, capital markets have been bumpy, just a little volatile. It took some time for lenders to get their hands around the market. In April and May, although most lenders claimed they were actively lending, many created roadblocks that stalled transactions. Some lenders even pulled out of lending commitments late in the transaction process. Lenders widened spreads to cover the perceived risk and uncertainty, and the agency lenders, Fannie Mae and Freddie Mac, increased their reserve requirements to boost their safety margins. But as additional information about the performance of commercial real estate has come in, with rent collections above 90% for most property types, many lenders have relaxed their restrictions. The average lender spread over the 10-year Treasury has come down from above 300 basis points in April to between 200 and 250 basis points. This has taken the average mortgage rate down to the low 3% range, though it can vary significantly depending on the property type, location, borrower strength, and other factors. Fannie and Freddie have also relaxed their reserve requirements a bit, but they could recalibrate depending on the risk they see in the market. As a result, the cost of debt capital is at or near an all-time low. This is spurring increased refinance activity, of course, although many property owners already locked in relatively low rates at some point over the last 6 months. But there are opportunities on the transaction side. In general, cap rates have held pretty steady, increasing marginally during the pandemic, but for some properties, the cap rates have even gone downward a little bit. But the yield spread between the current cap rates and the cost of capital have widened. On average, the yield spread between mortgage rates and cap rates has widened to between 250 and 350 basis points, depending on the property. This is some of the strongest positive leverage we've seen. In addition, property income has faced some pressure. While collections on most property types are above 90%, that does leave some value-add opportunity for investors once we get past the pandemic. This means that yield potential for restabilized assets could be stronger than many investors perceive. There's a record volume of capital waiting on the sidelines for a wave of distress, but so far, very few distressed assets have come to market. So while opportunistic investors wait for significantly discounted deals to eventually emerge, other investors are capitalizing on low interest rates to bolster their levered returns. There's a lot of uncertainty that investors must consider, but locking in financing in the 3% range offers considerable operational latitude and upside going forward. So while many investors are waiting for real estate prices to fall, that may or may not happen. In the meantime, favorable opportunities that factor in the cost of capital are missed. And over the long term, thinking beyond the health crisis, many of these assets offer upside potential. Seasoned real estate investors are thinking forward. They're keeping their eyes on the horizon.